Hello people. So I am again back with a new video where we are going to learn about inventory. It's a PwC guide for December 2021. It's a pretty old guide, but I believe there is not any much changes in this. So first I will introduce myself. My name is Jatin Gupta and by profession I am a chartered accountant and currently working with the PwC service delivery system where I am involved in the US engagements, where I work closely with the US engagement teams and provide support in the audit engagements. So first I tell you why I am reading this. So recently I have come across a client where there is a need to be testing of inventory provisions. Okay, so for that I need to understand like why the provision I have to refresh or upskill myself regarding why the provisions is booked on the inventory. I have a pretty understanding like the inventory is pretty obsolete, then we should book a provision on the basis on certain percentage. But since it's a retail client, so I just thought to get a little background relating to US GAAP also, if there are any changes or something different or some other concept that I need to be aware of before working on the engagement. So it's basically talking about inventory costing. Okay, so inventory costing is so let's just first import it to the good notes. It's into the IFRS new folder, inventories, done. Yeah, it's pretty done. Okay, so taking this, so first chapter is our inventory costing. So let's see what are the different chapters. So this is inventory costing, and next chapter will be the, what's the next chapter? Retail inventory method, closing our other books. Yeah, chapter 3 is LIFO inventory, correct? Okay, so it's not a very big, it's only a 48 pages. Okay, so I guess I can complete it by in one day. So primary source of existing FAS authority guidelines is available in SEC 330, which is about inventory. Okay, so it's pretty, this guide assumes the adoption of 606. It's a new revised revenue recognition principle. So if you are doing in IFRS, it's IFRS 15 and Ind AS 15 if you're doing in India. So 606 is the standard name, accounting standard. I think this is some full form of ASC. So ASC 330 sets forth general principle related to determination of cost of inventory. Okay. In speaking of simple term, cost of inventory is simply historical cost, or so how we determine the cost of the inventory at the end of the reporting period. Net realizable value of cost, whichever is lower, and what is included in cost, it's a different thing. Determination at cost of inventory, it's applicable. Okay, and subsequent measurement is lower of cost or market value, or lower of cost or net realizable value. Okay, when we use market value and when we use net realizable value are both are different things. It means if it's a normal stock, then it should be net realizable value, and market value is, I think, when the entity is in liquidation or is not following going concern concept, then it should be market value or cost, whichever is lower. Inventory, the aggregate of those items of tangible personal property that have any following characteristic held for sale in the ordinary course of business. So if a company like DLF holds something like anything other than in the ordinary course of business, then it's not for inventory. In the process of production for such sale, Yeah, it is in the position. So it's a trading of final goods. These are get WP, and these are raw materials. Are in currently consumed to the production or available for sale. To be available, so which specific cost or portion thereof would be acceptable for capitalization as inventory cannot be addressed generally, but okay, generally address नहीं हो सकता, but vary by industry and will depend upon the individual facts and circumstances. Okay, it's a general idea. But speaking about generally, so any cost incurred, most of the cost incurred till the inventory is used for the production is does form part of it. Include then we also include borrowing cost if any. Consignment arrangements. In some situations, the reporting may enter to a consignment arrangement with vendors relating to the purpose of raw material used in the production of finished goods. Con 8 defines an asset as a present right of an entity to an economic benefits. In the context of inventory purchases, we generally believe control is conveyed through title transfer. Okay, it's generally okay. However, consists of A, an asset is transferred when customer obtains control that asset. Therefore, the company may have an asset before the title is transferred. So, as per the new revenue recognition, even if the asset has not been transferred, the title has not been transferred, but its control has been transferred, then it is deemed to be transferred, then inventory, because control of the asset has transferred. Okay, so the following are some factors that an entity should consider in determining whether the company's control, who is responsible for goods if they are stolen. It's pretty obvious, become obsolete. Who bears the market risk as it relates to the price fluctuation volatility? Can a vendor unilaterally take back the inventory? The vendor unilaterally, without any conditions. Swipe out the inventory or mix, change the mix. Can the company return the inventory other than due to defects? Has the company accepted the inventory? So these are some. So refer to the RF for consideration with the transfer control and for guidance on consignment arrangements. So it's a different concept. Consignment involving certain commodities. It's not of our use. This is our main topic, inventory costing. Okay, so here we are going to talk about costing. The primary basis for accounting for inventory is cost, provided cost is not higher than the net amount realizable from the subsequent sale of inventory. It's pretty obvious, it's repeating itself. Cost may be determined using variety of cost flowing assumptions such as FIFO, average, LIFO, average and LIFO. Regardless of the cost flow assumption chosen, the nature of the cost includable in inventory will be consistent. Okay, nature will be consistent. Although many companies may use a standard costing approach, many companies may use a standard costing approach in their operations. Okay, for financial reporting purpose, variance between actual cost and standard cost must be absorbed so as to reflect actual cost in inventory, subject to consideration of A. So these are using standard costing principles to determine any variances. Cost element, inventory elements of cost. Okay, the definition of cost applied to inventory means the definition of cost applied to inventory means, in principles, the sum of the applicable expenditures and charges directly or indirectly incurred in bringing an article to its existence. Any sum applicable expenditure or charges directly or indirectly incurred to bring article to its existing conditions and location. So it's a general definition. This is a very general definition. It is understood to mean acquisition and production cost, and its determination involves many considerations. Abnormal costs related to freight, handling, and waste materials should be spoilage. Should be included in current period charges rather than deferred as a proportion of the inventory cost. Okay, any abnormal costs related to freight, it should be included in current period charges. It should be recognized in the current period. It's obviously in the context of freight and handling, abnormal generally means those costs related to the activity that are duplicative or redundant. That is not a normal element of supply or chain. Okay. Like example, movement from warehouse to another warehouse as a result of a unplanned shutdown at the primary manufacturing facility or natural disaster. These are abnormal activities. Higher than normal or expected than anticipated cost or otherwise routine activities are not abnormal cost in this context. Pretty good. In addition, the concept of wasted material spoilage refers significantly to goods that are damaged or destroyed or lost during the production process, merely occurring of higher cost when acquiring inventory from third parties is not considered waste material. Merely incurring higher cost when acquiring inventory from third parties, it's not is not considered waste material. Those higher costs should be capitalized subjected to the lower of cost and realizable. If anyone purchases at a higher cost but its realizable value is very less, so it should recognize inventory at lower price. Companies that hold or enter into companies that hold or enter into firm commitment and purchase inventory that are commodities or to protect against fluctuation in market price of inventory may enter into a future contract to hedge price risk associated with such inventory. Okay, so enter करती है into purchase inventory that are commodities. Okay, if commodities में so उनके fluctuations के against hedge होने के लिए so enter into future contracts or price associated with inventory. So ASC 815 is about, I think, financial instrument. All derivative instruments must be recognized and subsequently measured on an entity's balance sheet at a fair value. The accounting of a changes on fair value of a derivative instrument for a period will depend on the intended use of the derivative instrument and whether it qualifies for hedge. See derivative for hedging guide. I think it's this. No issue. And guidance on issuance accounting for hedging. So we are reading this definition of derivatives. Okay, we are on the chapter 2 for this. That we have covered in the previous video. I will just link for the video of the chapter 1 in the above I button. You can access that. Okay, so lower of cost and net realizable. What's the meaning of this? For inventory measured using any method other than LIFO, because in some standard LIFO is not allowed, like in Indian standard LIFO is not allowed, and for retail inventory method, okay, it's our main method. Like this is our priority. Like for this we have started, I have particularly started reading all this. The lower of cost or net realizable value rules as the guidance principle for measuring inventories. For inventory measured RIM, refer this. For measured loss, refer 3.8. Okay, we will cover it different topics. So what is net realizable value? So 330 define ASC 330 defines net realizable value as estimated selling price of in the ordinary course of business less reasonable predictable cost of completion, disposal and transportation. Less predictable cost of completion, so selling price less what could be the cost of completion if they are in WIP, and if they are disposed, if we have to sell, we have to incur some cost in selling and its transportation. So subtracting all this, we come to net realizable value. Additionally, ASC 330 states that no loss should be recognized on inventory unless it is clear that a loss has been sustained. No loss should be recognized unless, it's a little confusing, unless it is clear that a loss has been sustained. Okay, I think it means if currently your cost is 100, okay, and your NRV comes out to be 90 due to certain market price, where the due to which the market price of the raw material of the inventory has come to very low, but it's a temporary situation, then you should not recognize it. It should be only if it is a pretty much permanent, unless it is clear that it is has been sustained. Okay, in applying the lower cost and NRV principle to raw material work in progress inventory, it is necessary to estimate the cost to convert these into the saleable finished goods in order to determine NRV. In determining the net amount related from the subsequent sales, selling cost should be included only direct items such as shipping cost, commissions on sale. It's a pretty obvious. Okay, I have to check what are the other testing I have to perform, like okay, so we have to I have for the particular client I have to test inventory reconciliations. Okay, it's not inventory. Test the cost of cost of resale inventory. Test counts to and from detailed inventory listing. Observe and evaluate the results of wall-to-wall observation using. Okay, it's a different thing. Test the inventory resale. Okay, substantive analytics. Okay, develop a plan for testing inventory and existence. Okay, I think we had a pretty good just an idea. Determining NRV at a balance sheet date requires the application of professional judgments and all available data, including changes in the product price that have occurred or are expected to occur subsequent to the balance sheet date. It should be, for example, increase in price subsequent to the balance sheet date. The agents of the fund would likely demonstrate that decline in price of the balance sheet was temporary and negate that the lesser or no NRV is required. Lesser or no NRV, so it's just this. However, subsequent decrease in price may indicate a need for an NRV adjustment at the balance sheet date. Thus, a decrease in selling price subsequent to a balance sheet date that is not. Okay. 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 Thus, a decrease in the selling price subsequent to a balance sheet date is not a result of unusual circumstances such as abrupt or significant but short-lived changes in the supply and demand for them. Generally, should be considered determining an NRV of your balance sheet date. Okay, I have to get a pretty big understanding about NRV because currently I have to test the net realizable value of inventory, and for that I am so I have, what are the situations that we have to consider for NRV? Like if it is a technology inventory, so then an old technology which is available in their inventory stock, so it's an obsolete technology, I believe. If it is more than 52 weeks, yeah, or 1 year, the company is considering it's obsolete. So how can we determine the NRV? Okay, it's so allowance for NRV. Okay, 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 okay. I am got it. Understanding. Company enters into a global restructure program under which it will close certain facilities. Okay, company A enters into a global restructuring. Okay, this is example for assessing subsequent and for inventory valuation. Okay. In January 2020, Company A enters into a global restructuring program under which it will close certain facilities and discontinue certain product offerings. Okay. Most of the product offering will be discontinued or currently profitable. The company will be executed in phases beginning on this and will continue for a period of 2 years. Each phase of the plan is subject to a several level of operational review and revisions before ultimate approval from the CEO. Product for planned discontinuation may be revised significantly during review and may be rejected by CEO. If products are discontinued, company A will attempt to sell the inventory at salvageably and discard it. Okay, the first phase is approved by the CEO in January, and prior to issuance of company's calendar India. Should the effect of discontinuance should be considered in NRV assessment? Of course, the impact has been considered, because there is no uncertainty, no, there is no certainty. Yes, okay. Although the product, but I think it should be of less, provision should be very less. All the products in questions are profitable at the balance sheet date. All information relating to the inventory valuation should be taken into account through the issuance of the financial statement. Okay. All information relating to inventory valuation. Company A had a global reorganization plan in place prior to the balance sheet date. The fact that the phase of plan in question was not approved until after the balance sheet date would not provide a basis to defer the loss. This is in contrast to when the specific event results in loss, such as due to post balance sheet fire. In that case, a clear triggering event occurring after the balance sheet date, the event would be impaired in the same period as the specified period occurred. So we have to consider its NRV. Okay. So in here, the company A's global restructuring program undertake कर रही है, in which it will close certain facilities and discontinue product offering. Okay. Now, profitable है, the plan will execute in phases beginning this and will continue to several level of operational review and revision. Plan for product discontinuance may be revised significantly during review and may be rejected by the. Okay, they are considering new products, but they are discontinuing, but their discontinued plan may be rejected by the CEO after a certain period of time. Okay. Units of accounts for NRV. How to units for account? Depending upon the character and the composition of inventory. Okay. The lower of the cost NRV test may be performed on item basis by majority category of inventory, or at any other level that most clearly reflects the periodic income which that loss are not inappropriately deferred. The method is used should be consistently applied. Okay. Raw material in, okay, this is important. Raw material inventory relating to single finished goods should be grouped together for the purpose of evaluating the need for an NRV write-down. Raw material inventories related to single finished product should be grouped together. Single finished product. Okay. Generally, there is no need to write down inventory component, individual component of a particular finished product if the net realizable value of the finished product is greater than the aggregate cost of component and cost of production and direct selling expenses. Generally, there is no need to write down individual component of a particular finished product if the net realizable value of the inventory is greater than the aggregate cost of the component. Then okay. The greater the diversification of finished goods inventory and line of business in which an entity operates, the greater the need for the care of determining the appropriate unit of account when performing a net realizable assessment value. In general, I believe it would be inappropriate to apply a broad entity-wise approach to the lower of cost when offsetting unrelated risk. Okay, we should not apply entity-wide approach. And like in the, okay, I have pretty, like if in a fashion industry, so there are jeans, so you can apply the concept of particular jeans, but there are different kind of jeans like low, bottom, and style. So NRV should be determined for them separately. Like in the jeans, there are category for kids, teens, adults, and like this. So category should be based on this also, age group also. So there should be a proper categorization about the unit of the accounts for the NRV assessment. We should not use entity based approach. Okay, adverse purchase commitment. Losses expected to arise from firm non-cancelable and unhedged commitments for the future purchase of inventory items should be recognized unless the loss are recoverable through firm sale contract. So into 330 and through 330. Okay, I have to read this a bit again, but I have pretty much understanding. Like, if the company has come into an agreement, non-cancelable agreement, where they are after the agreement they are incurring losses, but if such loss is recoverable through firm sale contracts, other contracts regarding this only, like if the this only, so this should be realized. But I don't understand, like, commitment for future purchase of inventory. How do we recognize? Like, I know I am buying a particular inventory at a particular cost, and it will be sold at itna, so the such loss shall be recognized. And how will we amortize it? Like, either amortization cost, SLM, or anything. Okay, if there is decline in inventory, so SC 270 and 330 requires that inventory be written down during an interim period to a lower of cost and unless it is reasonably expected that the net realizable value will recover before the earlier of the inventory being sold and end of the fiscal year. Situations in which an interim write down would not be necessary are generally limited to seasonal price fluctuations. Okay. Okay. Requires inventory. I think I have to keep it on hold. This topic, decline inventory at okay. Mark to market inventory, I have a pretty much understanding. Like, inventory includes stock. Okay, the for a asset management company or some other investing company, inventory includes stock, so they are mark to market, so they should be marked at precious metal having fixed in monetary value with no substantial cost of marketing may be stated at such monetary value. Any other exceptions must be justified in inability to determine appropriate approximate cost immediate market. Certain inventory is applicable for this. We expect circumstances in which inventory can be carried to market to be extremely rare. In particular, ASC 932 provides accounting guidance for oil and gas companies and specifically prohibits measuring physical inventory at fair value except when indicated by the authorized legislature. Okay, it's a different concept. Okay, precious metals. Okay, I have understood now. Precious metal like gold have fixed monetary value with no substantial cost of marketing may be stated at such monetary value. So it should recognize at the price on 31st December or at the end of the reporting period. Except when expenditure indicated by the authority legislation, no basis exists for carry inventory at fair value. For example, if the broker dealer subjected to a specific guidance on 940 ASC 940 financial broker and dealer, then certain of its commodity inventory may be reported at fair value. However, we believe that the inventory must be specifically within the scope of 940 and cannot if it is outside the scope. Fully absorption costing. Okay, it's a basic costing method. Fully absorption. Okay, how are we fully absorption? And then inventory costing method. They made vendor rebate, cost of goods sold, mercantile. Okay, I have a pretty good understanding. Now we can understand what is full absorption costing means. Inventory is initially measured at cost. Okay, it's determined at cost, which include cost of material and other finished goods and cost incurred directly or indirectly in production, which includes labor and overhead. Full absorption costing refers to a process of allocating or absorbing overhead into the cost of inventory. Like, I have buy 100 units at a price of 50, So I have 5000 units, 5000 costing, but in that 100 I only utilize 80, so I cannot allocate the whole costing of 5000 of the 100 units to my PNL, because it will show wrong profits. That's why we are having closing stock on the credit side. But let's not talk about PNL. Let's talk about in general. Like I have to make a decision, like in the decision making on something else, like we have to continue this product or not. So we have to determine, like we have only used 80% of the inventory, no, for the particular finished goods. So we should determine only the cost of 80 units, not for the 20 units. So this is the method of absorption costing. So this is a allocating method. So full absorption costing is one of the method. So ASC 330 through 330A indicates that variable production overhead cost should be allocated to each unit of product on the basis of actual use of production facilities. The allocation of fixed production overhead cost, however, is required to be based on normal capacity of the production facility, which is defined as the production expected to be achieved. Okay, again, the allocation of fixed production overhead cost, however, is required to be based on normal capacity of the production facilities, okay, which is defined as the production. What is normal capacity of production? Production expected to be achieved over a number of periods under normal circumstances, taking into consideration loss capacity resulting from the plant maintenance. The range of normal capacity will vary based on business and industry factors. So full absorption costing says variable production overhead should be considered in valuation of inventory, and we also consider fixed production overhead. Okay, example, like we incur 20 units per unit on a particular purchase, okay, and we have to incur, and for purchase the material, and we have to incur like 10 per unit, like labor and other materials also, labor and factory electricity to incur, so its cost to be 30. But what about rent, like factory rent? The factory rent is not considered here because it cannot be determined in units. So full absorption costing says we have to include allocate fixed. So it says no, we have to allocate fixed overhead. However, it is required to based on the normal capacity. So we have to assume like a rent is of 200,000, okay, per month, and in 1 month we are expected to make, let's say, 40,000 units, okay, let's say 40,000 units. So for per unit rent is 5, so we have to include 5 in this, so 35. So this is 40,000 is our normal production capacity. So 40,000 is our normal production capacity. So what is normal production capacity? It's achieved over a period of number of periods. Normal circumstances, I consider like 40,000 is after maintenance, like there are some maintenance issues, anything which can be produced. 40,000 is my general capacity of my, like we can make 45,000, but 5,000 is the general defective product, is that, okay. Full examination tax consideration. Now tax is not my area of expertise. There are specified rules for cost that must capitalize into inventory and that may desire variation up to a for tax purposes. I also consider like which ICDS income disclosing standard, income computation disclosing standards. So these are the Indian like guidance of how to disclose. It's in relation to the accounting standards in India. So it's the taxation standards which are pretty much similar to Indian accounting standards. So they are applying like what are the rules to be followed for the inventory capitalization purpose or anything. So state that the fact that cost is capitalized for tax purposes does not itself indicate that it is preferred or even inappropriate. 330 states that the fact that a cost is capitalized for tax purposes does not itself indicate that it is preferable or even appropriate to capitalize that cost for financial reporting purpose. Both can be different. Certain of the additional costs that are required to be capitalized for tax purposes may also be capitalizable for financial reporting purposes. Similarly, certain costs that are required to capitalize for may also be capitalized. There are similar, like in the financial reporting you can capitalize it, and as per tax you can also capitalize, depending upon the factors such as nature of an enterprise operations and industry practice. So for examples के लिए we have to refer this. Okay, it's a pretty much simple. Cash flow assumptions. Okay, what are the cash flow assumptions?